have talked about the 5 basic journal entries for the equity method. Now let's look at some additional issues. The first issue is, what if investee has other comprehensive income? What should investor do in this situation? So the journal entry for investor in this situation is to debit investment account, credit other comprehensive income of investee. This is very similar to when investee reports income. So when investee has OCI, investor recognize an increase in OCI similar to an increase in equity investee income we discussed earlier. You can just compare this journal entry with the journal entry we did previously. It's very similar to when investee reports earnings. It's just in this situation, we're crediting, instead of credit equity investee income, we're crediting other comprehensive income of investee, which is an OCI account for investor. And then the second situation is, what if investee has a loss? So if you recall previously, when investee reports an earning, the journal entry we make is to debit investment account, credit equity investee income. And what if investee has a loss? In this situation, investor's journal entry is to debit equity investee income, credit investment account. So this journal entry is exactly the opposite. Is exactly the opposite as what we did when investee reports an income. And then the question is what to do. So as you can see here that in this journal entry, whenever investee reports a loss, investor would decrease its investment account. So what should we do when investment is reduced to 0? So when investee is keep reporting losses, investor would have to keep reducing its investment account. And then what if investment account is reduced to 0? Should investor establish a negative investment balance? So can it be negative, the investment account? And the answer to this question is no. Investor should discontinue using the equity method in this situation. And then when should the equity method be resumed? So when can we resume using the equity method? And the answer is when subsequent profit eliminate all unrecognized loss. So even though investors stopped using the equity method, it is still kind of keep a booking how much losses investee has recognized and how much losses it should recognize for itself. Even though it has stopped using the equity method, but it is still keeping track of all of those unrecognized loss. And then when subsequent profit, when investee begins to make profit again, and all of the subsequent profit is enough to eliminate all of the unrecognized loss, that is when investor can resume using the equity method. So this is the loss situation. And what if instead of a loss, there's a decline in investee's fair value? So should investor do anything in these situations? More specifically, should investor recognize impairment in this situation? And the answer is yes, but it comes with a condition, which is but only when decline in investee's fair value is permanent. So it is only when investee's decline in fair value is permanent does investor need to record an impairment. Otherwise, investor doesn't need to do anything. And the journal entry here is to debit impairment loss, credit investment account. So all of the journal entries we're talking about here, those are journal entry for the investors. We don't care what journal entry investee is making. We only care from investors' perspective, it is making an equity investment and what kind of journal entry it should make associated with this equity investment. And then here's another situation. What if there's a change to the equity method? So what do we mean by here? So the change to the equity method, it can more specifically be two situations. It can either be a change from the fair value method to the equity method, or it can be a change from the equity method to the fair value method. So let's first look at if it is a change from fair value method to the equity method. So you can just kind of just read it here, but the key word here in this slide is we don't do retrospective adjustment. We just take whatever we have now and adjust accounting prospectively. So we only do prospective adjustment here. And then what if investor sells the investment? So if part of the investment is sold during the period, and then this is basically what if the selling of investment cause investors from using the equity method back to the fair value method. And then still the keyword here in this slide is prospective. We don't need to do any retrospective adjustment. We only adjust everything prospectively. And then, so these two slides, you can just read it on your own, but I do want to go through an example here which explains these two slides. So here's the example. Company Big paid 27,000 for 10% of the outstanding voting stock of Small. So as you can see here that 10%, which means that the firm uses the fair value method. Small's book value is 210,000. During 2017, Small reported net income of 60,000, declares dividend of 10,000, and at the end of the year, Small's fair value is 300,000. So here, because the firm is using the fair value method, does it matter Small report net income 60,000? Does it matter for Big? No, it doesn't matter. But does Small declares dividend of 10,000 matter for Big? Yes, it does matter. And the change in fair value, it matters as well. And then in 2018, Big purchased additional 30% of Small for 90,000. So now how much ownership does Big have? Big initially has 10%, now plus 30%. So the ownership now becomes 40%, which means Big can now use the equity method. Small's patent is undervalued by 30%. Patent has a remaining useful life of 5 years. Like we need to do some amortization here. And Small report 50,000 net income, 10,000 OCI. Small declares dividend of 10,000. Small's fair value of 360,000. So, and then in 2019, Big sells 10% of Small for 40,000. So what are the journal entries? I'm going to give you 5 minutes to work on this example on your own. And then I'm going to go over the solution. Please pause your video for now. Okay, so let's go over the solution. On January 1st, 2017, Big paid 27,000 for 10% of the outstanding voting stock of Small. The journal entry here is to debit investment account for 27,000 credit cash. And then in the year of 2017, Small report net income of 60,000. This doesn't matter for Big because Big is using the fair value method. Small declares dividend of 10,000. This matters for Big, and Big needs to report it as its dividend income because Big is using the fair value method. So the journal entry is to debit dividend receivable, credit dividend income. And because Big owns 10% of Small, so 10% multiplied by 10,000, total dividend paid out by Small, declared by Small, that is 1,000. So that's how we get 1,000 here. And then Small's fair value is 300,000. So 300,000 is the smallest end of the financial reporting period's fair value. Maybe I'll just 300,000. And then what is the book value of this investment reported on Big's book? That is 27,000. So the fair value for this 27,000 at the end of the financial reporting period is 30,000, which means that Big needs to increase its investment by 3,000. So we debit fair value adjustment for 3,000, credit unrealized holding gain for 3,000. And fair value adjustment is a balance sheet account. It is part of the firm's investment account. And as of the end of the financial reporting period, Big's investment account has a balance of the beginning balance. The beginning balance after initial investment is 27,000 plus 3,000, which is fair value adjustment. So the ending balance for the firm's investment account is 30,000. And then in the year 2018, Big made another 30% investment in small. So now we're moving to the equity method, 10% plus 30%. Now we have 40% ownership in small. And the general entry associated with this investment, this initial investment, is debit investment account credit cash. So for the amount paid by Big, which is 90,000. And also, Small's patent was undervalued by 30,000. The patent has a remaining useful life of 5 years. Small reports 50,000 net income and 10,000 OCI. So let's first look at this net income. Small reports 50,000 net income. 50,000 multiplied by 40%. So that's 20,000. So Small's net income is recorded as the portion which belongs to Big is recognized as income for Big as well. So from Big's perspective, it will increase its investment account by 20,000, credit equity in Small's income for 20,000. And then Small reports OCI of 10,000. And this 10,000 OCI multiplied by 40%, so that's 4,000. From Big's perspective, it will increase its investment account by 4,000, credit OCI of Small by 4,000. And it also declares dividend of 10,000. So 10,000 multiplied by 40%, that's 4,000. And from Big's perspective, dividend declared by Small, that is viewed as a decrease in the investment account of Big. So Big would debit dividend receivable of 4,000, credit investment account of 4,000. And then let's look at the last journal entry here, which is to record the amortization of excess payment. And as you can see here, the excess payment is identified, can be identified to a patent which is undervalued by 30,000. And this 30,000 can be amortized over 5 years. And also because Big now has 40% of Small, so multiplied by 40%. So the amount of amortization which should be recognized by Big is 2.4 thousand. And the journal entry here is to debit equity in Small income, credit investment account for 2.4 thousand. So now after all of those journal entries, let's look now at what is Big's investment account balance. So as we talked about previously, at the before Big purchased this additional 30% ownership, its investment account has a balance of 30,000. And then in the year 2018, Big made another 90,000 investment in small. And then this 20,000 net income recognized by small during the period can be viewed as an increasing in its investment account. The 4,000 OCI by small is also increases big's investment account. And then we take out 4,000 dividend, which paid by small, then take out 2.4 thousand excess payment amortization. So the ending balance for big's investment account is 137.6 thousand. And then let's look at what happened in 2019. In 2019, big sales 10% of small for 40,000. And the general entry we make here is to debit cash for 40,000 because by selling those 10% ownership in small, big gets 40,000. And then big needs to reduce its investment account in small in proportion to the percentage it sells. So how much should we recognize here? We just talked about the ending balance for the investment account. So investment account before the sale has a balance of 137.6 thousand, and this is corresponding to 40% ownership in small. So now we need to sell 10% ownership in small. So the question is, how much is this? So in order to calculate this, we just divide this 137.6 thousand by 40%, and then multiply by 10%. So it's just like take 1/4 of that. And this gives us 34.4 thousand. So this is the amount that needs to be reduced in BIC's investment account. And then the difference between these two, between the 40,000 and 34.4 thousand, which is 5.6 thousand, that is a gain of sale of the investment investment. So yeah, so this just explains how we get those numbers. So in this example, after the selling of this 10% ownership, big still has 30% ownership in small. So it is still not going back. It is still using the equity method. It is not going back to fair value method. But in some other situation, if big sells enough shares in small, it will need to go back to use the fair value method. So, and then there's a last additional issue I want to talk about, which is what if there is inventory sales between investor and investee? So some of the examples are Coca-Cola, FEMSA sells 1 million Coke bottles to Coca-Cola company. So Coca-Cola, FEMSA is a bottling firm for Coca-Cola, and so this is an upstream sale. And then in the other example, Ford Motors sells 10,000 cars to Ford Solars. Ford Solars is kind of like a dinner for Ford Motors. So this is kind of like a downstream sale. And in this, both of these situations, earnings process is not considered complete at the time of original sale. Recognition of the related profit is deferred until buyer's ultimate consumption of all disposition of the goods. So when there's an intra-entity sale between the investor and the investee happening here, we do not view the earnings process as complete because it is essentially part of the earnings. It's not, do you think a firm can recognize earnings when it is selling to itself? So of course the answer is no. So that's why we cannot recognize earnings of this intra-entity sale between the investor and the investee. And then specifically, what general entry should we make to defer this part of the sale? So for both upstream and downstream sale, we make the same general entry and the calculation is exactly the same. but the logic is a little bit different that I'm going to explain it shortly. First, let's just look at the calculation. Calculation, the profit that should be deferred is the profit of the intra-entity sale multiplied by the percentage of sale that is unearned, multiplied by the percentage of ownership. And the journal entry to defer the profit is to debit equity investee income, credit investment account. So as you can see here, this journal entry is exactly the opposite as when investee earns income. And if subsequently the buyer of that inventory is able to sell it to a third party, at this time we view this earnings process as complete. So we can recognize the intra-entity profit. At this time, we can recognize the deferred intra-entity profit. And what we do is just to reverse the previous journal entry by debit investment account, credit equity investee income. So let's look at an example here. Big owned 30% of Small and applies the equity method. In 2015, Small bought inventory cost $54,000 and sold it to Big for $90,000. On December 31st, Big still hold 20% of the merchandise. And the question is, what amount of unrealized profit should Big defer in reporting its investment in Small? So I'm going to give you 5 minutes, work on this example, and then we're going to go over it. Please pause your video for now. Okay, so let's go over the solution. Big owns 30% of Small and apply the equity method. Small bought inventory cost, so the cost of inventory is $54,000 and it sold it to Big for $90,000. How much profit is recognized by Small? So that is 90,000 minus 54,000, right? So that's 36,000. That is the profit recognized by Small. And for Big, it is able to sell 70,000, but it still holds 20,000 of the inventory at the end of the financial reporting period. So how much profit should be deferred? And then how do we calculate here? Small earned 36,000 from this sale. And then when Big is using the equity method, Big can recognize part of Small's net income. So Big is recognizing 30% of that. But out of this sale, out of this 90,000 sale, only 70,000 is eventually sold to the third party by the end of the financial reporting period. The other 20,000 is actually still remain within the firm. So this earnings process, this 20,000 is not completed yet, which means that we cannot recognize this part of the earnings. We need to defer it. So the amount that should be deferred is 36,000 multiplied by 30%, multiplied by 2019. So that's 2,400. And the journal entry here is to debit equity in investee income, credit investment account for 2,400. And of course, if Big is finally able to sell this 20,000 inventory to a third party, maybe in the next year, Big can reverse this journal entry in the next year, which is just to debit investment account, credit equity investee income for 2,400. And then we have another question here. What if it is Big sold its inventory to Small? So let's look at this example. Big owns 30% of Small. And what if, in the previous example, it is an upstream sale? And now what if it's a downstream sale? Yeah, downstream sale like this. So it is now big purchased those inventory for 54,000 and sold it to small for 90,000, and small sold 70,000 of those during the year, and 20,000 remain within the firm. So how do we look at this situation? How much is the profit big made from this sale? So big sold it to small for 90,000 minus 54,000. That's 36,000. That is recognized on Big's book. But if you look at this 36,000, how much of it really is intra-entity sale? So 36,000, because Big owns 30% of small. So only 30% of this sale is intra-entity sale. And the other 70%, it can be viewed as selling to some other shareholders of small. So it is not really intra-entity. And then all of this sale, at the end of the financial reporting period, small is able to sell 7 out of 9 of this inventory, and only 20%, 20 over 90 remain within small at the end of the financial reporting period, which means that only 20 over 90 needs to be deferred of all of this intra-entity sale. So what we get is 2.4 thousand again. So as you can see here, the numbers we get, no matter whether it's upstream or downstream sale, are exactly the same. But the logic, there's a subtle difference in the logic here. And then the journal entry, again, it is exactly the same. It is to debit equity in investee income for 2.4 thousand, credit investment account for 2.4 thousand. So this is the journal entry. And then of course, if in the next year, if in the next year, small is able to sell all of this 90,000, so the remaining 20,000, small is able to sell it to the outside party, Big can reverse this journal entry in the next year, which is to debit investment account, credit equity in investee income. So here are the solutions that you can take a look yourself.